Right now, at this exact moment on March 20th, 2026, gold is trading somewhere between $4,718 and $4,732 per ounce, and silver is clawing back from a brutal week, sitting near $73.55 to $74.66. And if you're watching this video and you think this is just another pullback, just another dip to buy, I need you to stop everything you're doing right now. Because what is happening in these markets today is not what it looks like on the surface, and if you don't understand the full chapter, the institutional games being played right now, the macro data that dropped this week, the structural supply crisis that Wall Street refuses to talk about on mainstream media, then you are going to get absolutely wrecked in the next major move. My name is JIANG, and welcome to Silver Signals, the channel where sophisticated traders come for the real analysis, the kind that protects your capital and positions you ahead of the herd. Today's video is going to be one of the most important I have ever recorded. We are talking 20 minutes of pure, unfiltered market intelligence covering gold, silver, macro context, multi-timeframe breakdowns, and a deep look at what the big institutions are setting up right now. You do not want to walk away from this one, so stay locked in because the move, I believe, is coming as closer than most traders realize. Let's set the stage with some perspective, because context is everything in this business. Cast your mind back to January 2026, just 2.5 months ago, when gold printed an all-time high of $600 per ounce, and silver went absolutely parabolic, hitting $121 per ounce. That was a historic moment, the kind of move that legends are made of, and unfortunately the kind of move that retail traders chased right into the top. Since that January peak, we have seen a correction that has been, and I want to be precise here, textbook institutional behavior, with gold shedding nearly $900 from its highs and silver collapsing almost 40% in a matter of weeks. Now, to the untrained eye, this looks like a bear market, and to someone who doesn't understand how money actually moves in these markets, it looks like the bull thesis is broken. But I'm here to tell you, this is not 2013, and this is not the 2020 COVID crash. In 2013, when gold collapsed from $100 down to $180, the macro backdrop was a tightening Fed, a strengthening dollar, and no structural industrial demand crisis. The correction was fundamentally justified. What we have right now, despite a hawkish Fed tone, is a silver market sitting on a structural supply deficit that the Silver Institute estimates has now persisted for over 4 consecutive years, with the 2025 deficit alone projected near 200 million ounces, and 2026 data shaping up to be even deeper. Let's zoom all the way out and look at the monthly chart for XAU-USD, because this is where the macro story lives. On the monthly time frame, gold has been in a clean, disciplined ascending channel since the 2018 lows around $175, and every significant pullback in 2020, 2022, and 2023 has respected the lower boundary of that channel and launched new legs higher. The January 2026 high at $5,608 was not a random spike. It was the measured move target off the 2022 consolidation, calculated from a Fibonacci extension of the entire post-2018 move. The current pullback is now testing what I call the macro confluence zone, a cluster of the 38.2% Fibonacci retracement, the 20-month moving average, and a prior breakout level, all converging right around the $4,600 to $4,750 zone for gold, which we already touched intraday today before bouncing. For silver on the monthly chart, XAG-USD shows something equally important. The January spike to $121 was an overshoot, a wick above the upper Bollinger Band on the monthly, and what followed is a brutal mean reversion back toward the $70 to $75 macro support zone. That zone represents the prior 2024 breakout level, the 50-month moving average, and a key volume node from the 2020 to 2024 accumulation base. Silver sitting at 73.55 today is sitting right in the heart of major monthly support. The long-term bull is intact. It has just been stress tested, and the traders who understand this will be the ones positioned correctly when the next leg begins. Moving down to the daily chart, this is where the real psychology of the market becomes visible and where I want to start talking about what the whales have been doing. Over the last 3 weeks, gold has printed 3 consecutive red weekly candles, the worst losing streak we have seen since the summer of 2024. Each of those candles has had a very specific pattern. A morning session push lower, aggressive wick down into support, and then a partial recovery close. That is a classic institutional stop hunt pattern, and they are shaking out weak retail longs before reaccumulating. The daily structure for gold is currently showing what technical traders call a descending wedge, a bullish continuation pattern in a broader uptrend where the highs and lows compress, volume declines, and the coil tightens before a fast and violent breakout to the upside. Based on the measured move of that wedge, a breakout targets the $5,000 to $5,100 range. which, not coincidentally, is exactly where JP Morgan is forecasting gold to average by Q4 2026. But before that breakout, we need to be fully aware of the bull trap risk at current levels. We have seen 2 false breakout attempts above $4,800 in the past 2 weeks, both of which failed and pulled back aggressively within 24 to 48 hours, signaling that there is still significant supply overhead. A break above $4,800 on strong, above-average daily volume, not a thin New York session pop, is what I need to see before calling a confirmed bullish reversal on the daily time frame. Now, quick pause here. If this analysis is giving you value and this is the level of depth you need to navigate these markets, please smash that like button right now. Drop your gold and silver price prediction for end of Q2 in the comments below. And if you haven't already, subscribe to Silver Signals because this is what we do here every single week. Now let's get into the 15-minute chart and talk about your actual entry setups for the New York session, because this is where the money is made or lost for active traders. The 15-minute chart is where the New York session wars are fought, and I am going to walk you through exactly what I am watching for entries in the coming session with specific price levels, targets, and stop placements. Gold opened the New York session today with an immediate rejection candle from 4,132, a 15-minute wick up into the overnight high, followed by a sharp $20 pullback. That is the machine running stops above the Asian session high, and it is completely classic institutional behavior. On the 15-minute chart, I have the immediate intraday support at $4,790 to $4,695 as the first key level, which is a prior consolidation base from the pre-market session, and aligns with a 61.8% Fibonacci retracement of today's intraday range. If gold holds above this on a 15-minute close, the bullish bias for the session is intact. Below that, the demand zone at $4,865 to $4,672 is where I am watching for a potential long entry if price revisits. But if we get a confirmed 15-minute break and close below $4,936, today's intraday low, all short-term bullish bias is invalidated, and we look for a flush toward the $4,600 macro support. For silver on the 15-minute chart, XAG USD has the cleaner and more compelling setup. Silver tends to lag gold on the initial move and then overperform on the continuation, a phenomenon traders call the gold-silver leverage effect. I'm watching the 73.80 level as the 15-minute demand trigger, and a bounce and hold above that level with bullish candle structure opens a move toward 75.50 as the first target, with the $77 to $78 range as the session swing target if momentum accelerates. Risk management on silver longs is non-negotiable. Your stop goes below 72.80, the low of the most recent 4-hour demand zone, and no wider than that, because disciplined stops are what separate traders who survive this market from those who don't. Now let's talk about why the long-term bull thesis for silver is arguably stronger in 2026 than it has ever been in history. Because this is the section that separates Silver Signals from every other trading channel out there, as we don't just trade the chart, we trade the reality behind the chart. The AI infrastructure boom of 2025 to 2026 has triggered a secondary demand surge for silver that most commodity analysts have dramatically underestimated. Data centers require enormous electrical infrastructure where silver's electrical conductivity, the highest of any metal on Earth, makes it irreplaceable, and industry reports estimated AI-related demand would add an incremental 50 to 70 million ounces of annual demand by 2026, above the 2023 baseline. We are now living in that reality, and the numbers are coming in even higher than the projections, which is exactly the kind of positive demand surprise that drives parabolic moves in commodities with inelastic supply. Layer on top of that, the solar photovoltaic story. Every solar panel on Earth uses silver paste in its photovoltaic cells, and global solar capacity additions in 2025 hit a new record, with China, the U.S. Inflation Reduction Act build-out, and the European Green Deal all accelerating deployments simultaneously. The photovoltaic industry alone consumed roughly 200 million ounces of silver in 2025, up from about 140 million ounces in 2022. And the forecast for 2026 is higher still, while each electric vehicle contains significantly more silver per unit than a traditional internal combustion engine vehicle, primarily in charging contacts and battery management systems. Global EV sales are on track to surpass 25 million units in 2026, and when you combine AI demand, solar demand, and EV demand against a 4-year structural supply deficit, you have the foundation of a commodity move that history will study for decades. On the macro side, this week's CPI print came in hotter than expected. Core CPI remains stubbornly elevated, and Fed chair messaging has been hawkish, signaling higher for longer rates as the baseline scenario, which is exactly where most analysts get the gold and silver call completely wrong. Yes, rising nominal yields pressure non-yielding assets like gold, but when inflation is rising faster than yields, which is the scenario we are now entering, real rates are actually falling, and that is historically one of the most bullish environments for precious metals imaginable. The DXY, the dollar index, is the key variable to watch here, because a DXY rejection from the 104 to 105 resistance zone, which I believe is imminent, would be the catalyst that ignites the next major leg higher across the entire precious metals complex. And let's not forget the central bank bid, which has been the single most underappreciated structural driver of this gold bull market. Central banks globally, particularly in emerging markets, the BRICS nations, and countries actively de-dollarizing their reserves, have been net buyers of gold for 18 consecutive quarters. The geopolitical tensions in the Middle East, ongoing sanctions regimes, and the weaponization of the dollar in the post-2022 world have accelerated reserve diversification into physical gold in a way that has never been seen before in the post-Bretton Woods era. This buying is price insensitive. They are buying regardless of whether gold is at $3,000 or $5,000, and that creates an extraordinarily powerful structural floor that prevents the kind of catastrophic drawdowns that bear market skeptics keep predicting. Let me spend a moment on market psychology and what the whales are actually doing right now, because the COMEX commitment of traders' data tells a very interesting story, with large speculators, hedge funds, macro funds, the hot money, having dramatically reduced net long positions over the past 3 weeks as this correction has played out. Meanwhile, the commercial traders, the refiners, the manufacturers, the hedgers, have been reducing short hedges, which means they are less concerned about price risk to the downside than they were at the January peak. And when commercials cover shorts and speculators liquidate longs simultaneously, you get a classic coiling setup that precedes explosive directional moves. Managed money gross longs in silver are near a 12-month low right now. And historically, when this reading is this depressed in a structural bull market, the subsequent 3 to 6 month returns in silver have been among the highest of any period in the commodities trading history. Here's the warning I need to give you, because Silver Signals is about protecting you, not just exciting you. Before the next major leg higher, I fully expect at least one more stop-loss hunting raid below the $73 level in silver, and potentially a test of $4,636 or even $4,600 in gold. The institutions need one final flush to maximize their long positioning before they allow the market to run. So if you're holding long positions right now, your stops need to be below the monthly support zones, below $72.50 in silver and below $4,580 in gold. Not tight, not emotional. Anything above those levels is just noise designed to shake you out. And the traders who get shaken out right here, right at the bottom of this accumulation phase, are the ones who will watch the next $30 move in silver from the sidelines with nothing but regret. The bull trap risk I am most focused on is a fast pop toward $77 to $78 in silver or $4,950 in gold that reverses sharply within 24 hours on no fundamental catalyst. That type of move is a classic liquidity grab above resistance, designed to activate the buy-stop orders of breakout traders and then immediately reverse against them. If you see that kind of move develop, especially on below-average volume in a thin New York afternoon or London session, do not chase it. Wait, let the move develop, let it show follow-through, and let it retest the breakout level as support before you add meaningful size. Patience at key inflection points like this one is not a passive strategy. It is the most aggressive edge a disciplined trader can possess, because it preserves capital for the entry that actually works. So where do we go from here? Let me give you my Silver Signals roadmap for the next quarter. Near term, the next 2 to 4 weeks, the base case is continued consolidation in the $4,600 to $4,850 range for gold and the $70 to $78 range for silver. And this is the accumulation phase where smart money is quietly building positions. Medium term into Q2 and Q3 2026, if the Fed pivots even slightly toward rate cuts or the DXY breaks below the 100 level, I expect gold to reclaim $5,000 and push toward $5,200 to $5,400, while a tightening gold-silver ratio from its current 63 to 1 level would imply silver near $90 to $95 per ounce in that same scenario. And in the bull scenario, Citigroup and BMO both have models suggesting silver could reach $100 to $220 by 2027 if the structural deficit continues to deepen, which is not a fantasy number when you understand the supply-demand mathematics we have just walked through together. Long term, we are in the early innings of a commodity supercycle driven by decarbonization, AI infrastructure, and de-dollarization. these are not short-term themes. These are decade-long structural demand shifts that are colliding with a supply infrastructure that simply cannot respond quickly enough. Silver mines take 10 to 15 years to develop from discovery to production, and the capex investment that should have happened in the 2010s when silver was cheap didn't happen because the bull market hadn't started yet. Now the demand is here, the deficit is here, and the supply response is years away. That is the setup of a generation in this metal, and the viewers of Silver Signals who position themselves correctly in this window, with proper risk management, disciplined entries, and the patience to hold through the institutional noise, are the ones who will look back on this period as the opportunity of their trading careers. Before I wrap this up, you have just spent 20 minutes absorbing the kind of multi-timeframe, macro-integrated analysis that institutional desks charge thousands of dollars a month for. And this is exactly the work we do here at Silver Signals, because I believe every retail trader deserves access to institutional quality thinking. If today's deep dive gave you clarity, if it helped you see these markets with more confidence and precision, please hit the like button, drop your Q2 price target for gold and silver in the comments below, because I read every single one and I will be replying this week. And if you are not yet subscribed to Silver Signals, hit that subscribe button and turn on the notification bell right now. My name is JIANG. Stay disciplined, stay patient, and remember that in these markets, the best traders are not the fastest. They are the most prepared. I'll see you in the next one.